welcome to the closing beat, everybody. Happy Tuesday. How you doing out there? Y'all keeping your dough straight? I hope so. We are financial advisors here at Jazz Wealth, and every day we come to you to talk about the stock market because we're one of the only advisors that actually focuses on this stuff. And I mean, it's important. It's like, this is your money, right? You shouldn't be out playing golf or doing whatever these guys do. Oddly enough, fun, quick little side story. We were invited to a conference, like the big wig conference, where like the Goldman Sachs people were going to be there and all the hedge funds and stuff. And Goldman Sachs called and said, we want to invite you guys. You and Eric need to come down to this conference. And we're like, well, we're not really conference people. I don't know. Like, you know what I mean? This seems weird. And they're like, no, it'll be a big hit. We'll get you in front of some people and stuff. You got to come to this conference. There's only one request that we have. And I'm like, oh, God, here we go. You know, I'm not falling for this stuff. I want to be independent, do my own thing. And I was like, all right, I'll hear you out. What do you got? And so the only request that we have is that you and Eric come to the conference wearing the very clothes that you normally wear. Don't put a suit and tie on, no collared shirts. Just wear what you wear. That'll be hilarious. And I got a kick out of that. You know, I'm like, I could just be me. I could wear my tennis shoes, little shorts, my little fishing shirt, ready to go. Okay, maybe I'll go. Anyways, that was kind of our fun story of the day. Market, not a fun story here for today, but if you want to try to recoup a little bit, jazzwealth.com/guess the Dow. Well, if you're closest without going over, we'll give you $100. Credit your account if you're a client. Remember, you want to credit your Roth IRA if you are a client and you do win. That is my advice anyways. So, you know, a little bit helps. Maybe we can help you guys out there. But today, we're going to talk about the markets. Today was a bit of a tough one. So remember where we stand. So if you look and kind of zoom out, see everything, you go, well, this kind of makes sense where we're at. We've been saying this like the last 5 days now. Nobody wants to be the first to buy above this line. It's just a technical area. So if you don't believe in technical analysis or you just never learned it, it's not your thing, you at least need to know that that's where we're stuck. Oh, let me draw this line out. We are stuck right here. And because everybody knows that we're stuck, and now it's obvious, it's clear as day, right? There's your overhead ceiling, right? There's no second guessing it. No one wants to be the first, right? You don't want to be the first to pay the highest price, in this case, the highest price of the year. So we keep just bumping our heads there. And today was really no different. It was just blame it on something. You blame it on banks. Can't blame it on earnings because that was really good there. Can't blame it on the Fed because they're not till tomorrow. Can't really blame it on econ news because that, you know, really doesn't start until tomorrow. So you have people going, give me a reason. Why should I buy now? And you basically have people saying, well, maybe I'll get out of the way and wait until the Fed makes their decision. We all know what they're going to say anyways. But maybe I'll just hold tight, and if we start moving higher, I'll join those people once I know we're clear, but I'm not going to dive in and be the first. And that's a lot of what you saw today. And I got a lot of emails from people saying, oh my God, it's a crash, and the bank's this or that. And it's like, no, there's nothing good to go on. There's no reason to convince people to invest more at higher prices. That boiled down, take every data point you want. Now, we're going to get geeky in a second, and I'm going to go through some things that really put a nice shine on it and everything. But if you're looking at the S&P today, inside the S&P, there are 505 stocks today. In fact, 293 of them lost more than 1%. So that's a broad sell-off. It's one thing if like Microsoft has a really bad day and the markets are down, and you can blame it on that. 293 stocks lost more than 1%. That's across the board, people just saying, I'm out. You know what? In the short term, take my money, put it in cash to see what's happening. I'm not going to play around with this game. If you look around the markets, really the driving sectors for the day were energy, thanks to the price of oil falling about 4% there, and the banks. The banks are still in the equation. That's still a conversation people are having. It's not doom and gloom. It's not contagion. I just don't buy that. There's nothing that's changed other than people's perception of investing in the bank sector. Is anybody standing outside the bank trying to get their money? Is anybody having trouble? Like, are you changing banks? No, that's like months old, you know? So what's happening here is people are saying, I don't like what happened to FRC, and I worry, I guess, that it could happen to others. Therefore, I will not invest my money in that right now. I would rather go invest somewhere else. And given that the Fed's going to talk, and I just don't know what's going to happen here, maybe I'll just hold on to some of that money for now. That's it. That's exactly what we saw today. Now, year to date, we have some trouble here. Right? So year to date, the S&P's performance has been driven by the largest stocks, okay? And the best way I can show that to you is right here. So what I did is I took the S&P and I said, show me 8 stocks that have the biggest pull to the upside on the S&P year to date. Not today. It's a one-day thing. We're talking about for the year. So for the year, look at Apple is almost 1% of the 8% gains in the S&P. In other words, it's done it's done a lot of the work. Microsoft is over 0.5% of the year's gains. It's up 27%. It's done a lot of the work. Nvidia, basically about the same there, up almost 100% year to date. It's done a lot of work. Meta, same thing. Amazon, Google, Tesla, or 2 classes of Alphabet there. Add all of those up, and you don't quite have half of the year-to-date performance, but 8 stocks, really 7, doing that, that's what's called low breadth, right? If you were to look at things like that. So we would say there's not a lot pulling the markets down, today being a slight exception there, but we have low breadth in the market, okay? And market breadth is just a simple way of saying how many stocks are participating in the rally, when there is one, and how many stocks are not participating in the rally there. So, going to get a little geeky for a second. Overall breadth in the market has shrunk to 1 standard deviation below the average. This is what people look at. I don't do this all day because I know this is probably glossy eyes for a lot of you there. 1 standard deviation below the average there, which is a first since 2020, would be COVID. And so it's a good indicator of short-term market performance. So we use things like this to go, should we expect the markets to outperform their average, or should we expect them to underperform their average, or is just nothing going to happen, right? And so when we look at this, we can look at the last 9 times that this happened here since 1980, going all the way back. There's 9 instances of this, and the S&P actually performs under what it does normally on average, right? Since just to take the average of all of that, you say, well, the last 9 times, if we find where breadth fell that far, we have underperformance in the short term going forward. Now, can we get even more geeky, right? You see what you're seeing on the screen there. You see how, basically what I'm pointing out is the lower the number, the less stocks that are participating in the rally. In other words, I go back a screen, we have a really low breadth right now because only these stocks, really, year to date, have done the heavy lifting. Everybody else hasn't really done a whole lot, aside from a few, right? And so that's truthfully not a really good sign there. Another thing to consider is when breadth is low in the market and there's only a few stocks participating on the way up and really nobody participating on the way down, at least aside from today, when that happens, the stock market has larger ranges. Okay, so let's take it a step further here. If we look in the short term, this is 1 month, 3 months, 6 months, and 12 months, right? You can see it there. If we look since 1980, median returns 1% over a 1-month time period, 3 for a 3-month time period, 5 for a 6-month, and 11 for a 12-month. When there is a 1 standard deviation drop in market breadth, again, this is a little geeky, we see underperformance in the short term, underperformance in the short term, underperformance, and underperformance, although it gets better as you go there. So with sharp declines in overall breadth, meaning only a few stocks lifting the market there, the overall range of the market gets wider and the returns, unfortunately, are not as good. Is that good news or bad news? It's good news for a lot of people because if you go to look at the stock market, you say, well, I didn't want to pay that if I didn't have to. And certainly I'm not going to be the first person to do it. So if it means weakness in the short term, I'm not saying catastrophe here, right? I'm saying, well, now we get a pullback. Maybe this is it. This helps, gets us towards the bottom of this range, and we can get excited again about buying stocks that are cheap or, relatively cheap relative to history there. And so you kind of hope that some of these stats are right. You hope that the breadth in the market stays really, really low. Maybe a few stocks take off and have a great run from here. But your investments, your 401k, your IRA and stuff, that's your chance to see it suck back just a little bit, dollar cost average cheaper. I get excited about that kind of stuff. That's, maybe that's just me there. Speaking of me, we manage our own portfolios here. So we don't take a day-to-day view. We take that portfolio level view. We've got to get to the end of the year with something good to write home about, right? So we always look, and fund managers do the same. There's actually articles, and you can look up different white papers and stuff on this. But what they do is they say, okay, what's our upside risk? What's our downside risk? That's what we need to solve for. Guessing the price that the market's going to be at is like fun, right? Guess the Dow. It's a fun thing to do. But does it mean anything for your portfolio? Not really, right? So we need to know downside risk, and is there anything we can do about that? Upside risk, and is there anything we can do about that? Let's start with the downside risk, and I'll just go over what we're thinking here with you. Downside risk, right now, if you take all the analysts, they call it consensus, but just basically the average analyst guess, 65% probability we go into a recession. Someone like Wells Fargo is a little higher. Someone like Goldman Sachs is at 30% or 35%. And it's like, okay, well, they all kind of average out at 65%. The recession is the downside risk, right? Because right now we don't have that actually priced in. But currently, if you look at what you call cyclical stocks, right? Stocks that perform in a strong economy, and defensive stocks, stocks that should perform in any economy, up or down, you can basically put those two together and see that the market's predicting about a 1% growth rate in the overall GDP, which is not great, but it's not really horrible there. And well, it is horrible, but relative to recent time. So separate topic for another time period there. But so looking at this, we go, okay, well, maybe there is a recession. And if we enter a recession, then right now you can actually look at the earnings per share of the market and say, well, what happens if we only have 1% growth? That puts earnings per share in the S&P at $200. So at $200, that means the S&P is only worth about $31.50. And I'm sorry, you can't see it. So let's pull it up here. So there you go. If we find that we only have 1% growth, the average earnings per share or the earnings per share for the S&P is, $37.50. So we're down here. Gives you a recipe for a bigger pullback. So your downside risk is basically the bottom end of this range, give or take just a little bit right in there. Healthy pullback. Again, not overnight. This is just if we start going to a recession. So what is that there? If we go from here, 37.50, about 10%, right? Yeah, it gives you about a 10% pullback. So is there a reason to believe at the moment? Is there any data point out there that someone can give me that says the market should be down 20%? No? No. I mean, you can have an expectation, you can, believe or have an opinion, but there's nothing that says that. 10%? Sure. Yeah, that's assuming we go into a recession, the Fed gets it a little wrong. The bond market currently pricing in the fact that the Fed has got it wrong and they're going to have to cut rates sooner than expected. Okay, that's fine. So that's your downside risk. What's the upside risk? Meaning you're not invested enough and the market takes off without you. That's the upside risk, or how you would talk about it that way. The upside risk is the Fed gets it kind of right and we're really going to focus on inflation. If there's a sharp decline in inflation, that's the upside risk specifically, though. Why is that? Anybody know? Anybody know why that's the case there? If there's low inflation, it means that it allows earnings per share, like per stock, right? Per individual company there. It allows those stocks to go higher without offsetting the downward force of their overall valuation, right? It means that you could take the S&P and say it's at about an 18 multiple right now, so 18 times forward earnings. I told you we're going to get geeky a little bit here today. It means that you could take it from there to 17. And that's below average. So the market becomes undervalued at that point simply because of a decline in inflation and at this point, I mean, even today, we could say we have higher earnings per share than we're factoring in at the moment. That means the market's value is actually, or should be, higher than it is. So that's the upside. Now that's a long shot, right? You know what I mean? Like, you see inflation falling. I've shared that with you guys in the past. You could, of course, see that happening, but not sharp. Like, we're not just going to fall to 2%, and it's like we're sitting through the summertime, sitting by the lake, having a few drinks, and you're like, it's 2% inflation again. You know what I mean? But that's the upside risk. Something's wrong there, right? So look at your portfolio, look at your investments and things, and even if you're not as geeky, just go, what's the upside risk? What's the downside risk? That's it. And then adjust for that. Or if you're a short-term trader, whatever it is that you do out there. Hey, I do want to point out again today, every stock besides Diamondback Energy beat on earnings. I'm talking all of them. Avis, Whole Logic, Marriott, Marathon Petroleum, NXPI Semiconductors, Pfizer, Uber, actually, would get lost less than expected there. Talk about that in a second. Zebra, you name it. The stocks that reported today, besides Diamondback Energy, they all beat on earnings. That's exactly what we've been talking about. They lowered the bar so low, they've given the market every chance it can for everybody to see it. Earnings are better than expected. Wow, look, everything's good out there. But we're all wise to that now, right? We started talking about this last month. They've lowered the bar. All we have to do is beat that bar by just a penny. And that's better than expected earnings. Right now, this is one of the best earnings seasons that we've had on record. But again, we lowered the bar. Right? It's like the curve in school. When they lower they say, well, nobody got it right, so we're going to lower the curve. You didn't do better. You just did a little bit better than everybody else. So we'll see. Crazy how they all beat. That's interesting to me. Let's do stocks in the news here. Okay. Go over here, and it's IBM is the first ticker symbol I want to look at. IBM says we're going to stop hiring people, and 7,800 of you that work for us, we're going to replace your job with AI. That's not a joke. I'm not, I shouldn't be laughing at that, but they're basically going to stop hiring. Then they're going to go look around, and they've already found 7,800 jobs they're going to replace with AI positions. So welcome to the future. Not them. We're going to go Marathon Petroleum is the next one on the list there. Back to the 200-day moving average. Nice little pullback for Marathon, by the way. So Marathon Petroleum, better than expected earnings. They beat, right? Revenues as expected there. And they said, you know what we're going to do? We've got extra money here. We got $4.1 billion in free cash flow. The current administration doesn't really like what we're doing, so we were only expected to have $3.3 billion in free cash flow. What could we do with the money? How about we buy back 10% of our shares? Yeah, they're buying back $5 billion worth of shares there, and that's the news, really, if you're looking at them. Restaurant Brands makes a new high here today. This is the company that owns like Tim Hortons, Popeyes, Burger King, Firehouse Subs, this is the company. So if you ever like, yeah, Firehouse Subs is pretty good. I wonder if I can invest in them. Right here, this is it. Interestingly, they beat on earnings by a lot, actually. Total revenues up 10% because of Burger King, right? Could you have guessed that? Like, it's Burger King and Tim Hortons, but we don't have so many of those around here. So because of sales at Burger King, is it? I mean, maybe the French toast sticks, but the rest of I was a little shocked by that one there. But nonetheless, you can thank them and Burger King and Tim Hortons for that. You guys like that stuff? I used to get those French toast sticks all the time. But I haven't been there in at least a decade. Burger King, just not at the top of my list. Okay, next up. Uber, really good earnings for them. I rag on them a lot. They are not profitable, so let's not get too excited just yet. But they lost a lot less than expected, and more importantly, their comments about this quarter and next quarter, and really for the rest of the year, they're predicting that they're going to continue to do that. So really good for them. All across the board, whether you're looking at deliveries, their subscription business, everything is really good. The only weak spot, and I sort of glanced through it, but the only weak spot there is if you happen to look at their total gross bookings, kind of like we look at Netflix and we say, well, subscriber count in the US go up, worldwide go up, did it go down, what happened? With Uber, you look at their total gross bookings, it did go down just ever so slightly. However, they're still taking more money, right? So they're squeezing a little bit more money out of their drivers, and I don't know how that continues, but it has continued. So good for them. Obviously, you want them to do well. But those are your stocks in the news for the day. Hey, tonight on Jazz After Dark, we're going to talk about a few really cool things that a wealth manager can do. And this is not like an advertisement or anything, but a lot of people look at a financial advisor or a planner and you only think of retirement. Well, their services may include a whole lot more. So if you've ever thought about doing some really wacky and creative stuff with your overall wealth or your building of your wealth, I'm going to go through some examples there, things that you didn't even know existed, we're going to go over tonight. And I'm going to take the approach that all of you have just walked into Goldman Sachs High Income Wealth Management Division, You've got at least 10 million bucks in the bank, so they're willing to open the door for you. And we're going to go through all the things that you can do, even if you don't have that kind of money. So that'll be tonight. And in the meantime, I will swap over here, try to take some of your questions. And tomorrow, of course, going to be a really busy day, but we've got the Fed as the major focus for the day. Probably the banks and stuff again. You know, that seems to be keeping the eyeballs on the TV, so I'm sure they'll talk about that a lot. You got Mercado Libre reporting tomorrow. Qualcomm. You got Qualcomm reporting tomorrow. Yum Brands, just Yum Brands America. Estee Lauder, CVS, a couple other, Cognizant, Albemarle, a couple other companies. Yeah. Today's show is like all other shows, Twilight Zone reading. Oh, man. I depressed you? What did I depress you for? I don't want to make you sad. He said, sorry, man, I had to take a call from my mom during the show, so I had to listen to you at double speed. I'm all caught up now. What happens if I talk faster? Could I outpace myself? Enphase or Alibaba, which one's more oversold and which has more upside for the future? Upside for the future, it seems like it'd be a little more plain vanilla kind of discussion there. But Enphase does have the government paying them a lot of money. Alibaba, you got that Chinese regulatory risk, which you always have with them. But I would look at it from that perspective. Which one has more of a guaranteed return on their current investment? Not your investment, their investment. Yeah. JW, Wine and Wealth. Yes, Wine and Wealth this week will be for the beginners. We're going to go over the dojo. We actually have a lot of cool things that we're working on here. But this week, we're going to focus on where you should be looking. If you're brand new to joining us, we try to do that at the beginning of every month. Try to say, hey, if you're new and you want to know all the tools and features and things that you can use, we're going to go over that. Absolutely. Ned Flanders. Hey, man, why don't we see Cody anymore?
Well, you can just hear me. It's all good. I'm here.
TV?
You took my camera. We don't have enough cameras. That's what it is. We don't have enough. No, we don't have enough. No.
Over there. But you know, Cody just apparently doesn't want to be on the old TV. on the YouTuber. I like it. Number one in financial wine and wealth. I appreciate that. Adios, Giovanni. Yeah, see, I think a lot of you are like Eloy there. You've been waiting for the pullback. You'll welcome it, so long as you know there's not a reason to worry about a bigger one. And I'm not like Mr. Perma Bull guy, and I'm always like optimistic and stuff. I want a pullback. I want there to be a bad reason that we get a pullback, but just a pullback. I don't want catastrophe, chaos. There's nothing there that says we should have that that we can go by right now. If banks typically lead the way down into a recession, do you think we're at the bottoming of the regionals? Well, unfortunately, so when people do studies about the banks, they tend to use the XLF. You can use like the Bloomberg Financial Index, I guess. That may go back a little farther, but for the midterm kind of studies, people use the XLF, and that doesn't include the regionals. So, I think that's a hard one to answer unless you're just focused on regionals. Definitely extended, but boy, that's a scary area right now, huh? Should we be concerned with Yellen talking about a default? I think last time, the 2011 going into 12 there, where the government shut down and we lost our credit, or we got a downgrade in our credit rating there, I think the market was down 17%. And there was a lot of this. We're starting to hear the rumblings of it and everything. I don't know where it ends up. I'm not going to guess like what our geniuses in Congress are going to do. But it's enough to cause a little concern out there. I'll give you that. Yeah. More reason for the pullback. Yeah. Thoughts on Apple? Thoughts of Apple Bank pulling money supply since they aren't making loans against deposits? Goldman Sachs relationship. Goldman Sachs is the the back end servicer of that. So I don't know enough to say I'm a part of that or know what they're doing there. But I haven't heard anything like that. aren't making loans against deposits. That part I'm not sure what the question is, because that's not what Apple does. You want to buy more NVIDIA, wait for a pullback. How much of a pullback should you look for? So you want to buy NVIDIA. What was it up? Yeah, prior to today, it was up 100% year to date. You want to participate in that one. I typed it wrong. Nope, sorry, NVIDIA. There we go. And you say, yeah, 100% I want on that. I want to be a part of that. Think about what happens there. When it does pull back, you have people with sizable gains that will say, I'm good with that. Let me take my profits. So when you get a pullback, why should it be a really short-term sort of just nothingness? It'll just take off again. It's going to go up another 100%. You know, there's not much reason for that. As you start having a more meaningful pullback, especially if it occurs with the whole market or the semiconductors, you say, well, people will start taking their profit. And so now I'm running into this fire sale or profit-taking sale. I don't like that sentiment there. Thanks. Well, you know, it's Dustin. It's not Justin. But I'm a student here. Oh, you're still okay. Cool. The way you teach us, we will all start managing your portfolios very soon. Could be the case. Put myself out of a job, huh? Worst case, you'll do it with data in mind, and you won't get so emotional when you read just the headline and go, well, I don't even need to know the story. There must be something wrong. If I could get people to do that, that would make me happy. All right, I'm going to wrap it up here and get on out of the way. I will see you guys tomorrow. Big day. Hope you're ready for it. Get a lot of rest there. We'll see you tonight for Jazz After Dark. If you want to see some cool things that wealth managers can do, we'll talk about some geeky stuff here tonight. Enjoy the rest of your evening. And at Jazz Wealth, we treat you like family. That was going to be our slogan, but the employees here took it a little too seriously.
You bought what? That wasn't in the plan that I built for you.
Oh, quit crying.
Don't spend one more dollar.
I'm gonna start calling you Sylvester because you sound like a real...
Tú siempre estás llorando como un bebé, llorancito.
I'm not mad. I'm just disappointed. That's how you get your identity stolen.
We decided to go with let our family be your family's advisor.